Welcome to the Deep Dive Briefing. It is November 5th, 2025, and, well, if you woke up and checked the charts this morning, you definitely saw some chaos. Bitcoin just went through a pretty serious stress test, diving below a psychological barrier that honestly felt utterly unbreakable just a few weeks ago. We are currently tracking the price at, let's see, $102,700. That reflects about a 5.8% drop in the last 24 hours. Now, that slide below six figures, yeah, it felt heavy. But here's the headline we've pulled from all the data. This current phase, it looks like healthy consolidation, not a structural reversal.
That's exactly the mission today. For you, the informed investor, we really need to cut through that market noise. So we're synthesizing the sudden market volatility, dissecting exactly what the long-term holders are doing, and layering in the latest macro forecasts, all to answer one critical question. Is this dip a chance to load up on value, or is it actually a genuine warning sign that the cycle might be topping out?
Okay, yeah, let's unpack this. Starting right with the price action itself, the intraday movement was, well, brutal. We hit a low of $98,900 before bouncing back up to $104,800, and the volume spiked 15% to $83.5 billion.
Whoa.
Yeah, which confirms that a lot of positions were violently unwound in a very short period.
What's fascinating here is the psychological impact of actually breaching that $100,000 threshold.
Yeah.
It was the first time since, June 2025.
Right.
And if you look at the order book, something like 40% of standing exchange orders were clustered right at that level. It provided some short-term support, but, well, ultimately it failed. And this whole event, it was really precipitated by an 18% correction measured from that October peak, which was way up at $126,200.
And, okay, when the price crashed like that, the derivatives market just had a massive cleanup, didn't it? We saw a shocking $1.7 billion liquidation wave hit those leveraged traders.
It was sharp, yeah, but maybe necessary. When we analyzed the CoinGlass data, 77% of those liquidated contracts were perpetual futures. The high-risk, highly leveraged bets, often averaging like 8x leverage.
Wow, 8x.
Yeah. And this event, it also coincided with a slight NASDAQ dip, so there was some external pressure. But its main function, a systemic purge. It really cleansed the speculative excess, cut open interest by 12%, and kind of normalized those funding rates that had gotten way out of whack.
Okay, but what about the technical indicators? Did they just flash red everywhere, confirming a deeper crash was coming?
Actually, quite the opposite. The 4-hour relative strength index, the RSI, it dropped sharply down to 32.
32? That's getting pretty low.
Exactly. That's technically approaching oversold conditions. And historically, hitting that level often precedes pretty significant rebounds, maybe 10-20%, usually within about 72 hours. So it suggests the sell-off was more momentum-driven exhaustion, not some kind of fundamental structural failure.
And here's the really crucial technical detail, the one that preserved the long-term trend.
Right.
Okay. We didn't just fall through the floor. We bounced right off the 50-week simple moving average, sitting right there at $103,000. Why is bouncing off a dynamic support line like that so critical?
Well, because that bounce effectively invalidates what looked like it was shaping up to be a head and shoulders bear flag pattern.
Ah, okay. The classic reversal pattern.
Exactly. A head and shoulders pattern is textbook evidence of a coming crash. So bouncing off that 50-week SMA, it means we successfully dodged a bullet, basically. And structurally, it preserved the multi-year bull market trend.
So the bottom line here, technically speaking, is that the resilience is holding up. What does that actually mean strategically for someone listening?
Strategically, what this tells us is pretty clear. View the, say, $98,000 to $100,000 range as a potential value zone, a place for dollar cost averaging. And this approach, it's strongly reinforced by historical cycle data. Similar mid-cycle dips have often yielded significant returns in the following quarter.
Okay, right. Makes sense. Let's shift then from the immediate charts to who exactly was selling during that dip, and maybe more importantly, who was buying. On-chain activity shows a 10% uptick in active addresses, up to around 950,000. That suggests smart money is deliberately repositioning, right? Not just panicking.
Yeah, and this leads us to a really fascinating divergence. The long-term holders, LTHS, those wallets dormant for 155 days or more, they recently distributed a massive $45 billion in BTC. They actually contributed about 60% of yesterday's downside pressure.
Wait, hold on a second. The original HO dealers, the people who supposedly know Bitcoin best, they sold $45 billion. I mean, that sounds like a top signal to me.
It does sound like that initially, but not when you look at where that capital actually went. Here's the massive twist. 70% of those LTH flows, they were immediately absorbed by institutional vehicles. specifically ETFs like BlackRock's IBO.
70%? Wow.
Yeah, so this looks more like sophisticated distribution, meaning robust demand, not just panic selling.
But retail sentiment completely collapsed, right? The fear and greed index dropped below 25. Google Trends is calling this max desperation.
And that divergence is actually essential for market stability. Retail capitulation, which you can see in a 15% Coinbase outflow spike, it directly provides the buy-side liquidity for those institutional buyers and those institutions. They now hold about 25% of the total circulating supply.
Okay, and you mentioned something counterintuitive before, that LTHs were selling into weakness, pushing the spend output profit ratio, the SOPR, below 1.0. Can you explain for the listener why SOPR below 1.0, which means people are selling at a loss, might actually be a good sign for a potential 30% bounce?
Yeah, excellent question. It really signals cycle maturity. When LTHs who've held for a long time finally sell at a loss, it suggests they're nearing capitulation after refusing to sell at higher prices. Now, this is kind of atypical for a mid-cycle, but when it happens, it effectively purges the last of the weak hands. It's a massive redistribution phase, essentially. It signals that the supply is migrated to stronger, probably institutional hands, which fundamentally enhances scarcity going forward.
Okay, got it. So we've established the technical defense held, and there's strong institutional demand absorbing the selling. Now let's turn to the big picture, those macro forecasts that anchor long-term conviction. Because, let's face it, without that macro vision, these dips just feel like pure chaos.
Right. And we probably have to start with Raoul Pal's thesis here. He's arguing that the bull cycle has been extended, potentially to a Q2 2026 peak. And he's projecting a cycle apex of, get this, $250,000 to $300,000.
$250,000 to $300K. Wow. What's the rationale?
His rationale is pretty straightforward. The maturation of these spot ETFs, they absorbed over $60.4 billion already. He believes this stretches the liquidity phase and the cycle duration far beyond what we've seen in historical norms.
And complementing that is the classic liquidity argument from someone like Arthur Hayes, right? He forecasts a market resurgence, but via the Federal Reserve's stealth quantitative easing. Is that the right term?
Yeah, that's his term. He points specifically to the standing repo facility expansion, the SRF. He thinks this could inject something like $1-2 trillion in liquidity by Q1 2026. And historically, this type of monetary expansion, it correlates pretty directly with, say, 50-100% BTC appreciation.
So money printer go brrr, basically.
Essentially, yeah. And then you have someone like Tom Lee, who ties the macro picture together. He links Bitcoin's path to $200,000 by year-end.
By this year-end,
Correct.
2025.
That's his call, yeah. He links it to an S&P 500 ascent. He notes the 0.85 correlation over the last year driven by AI gains and anticipated rate cuts. Plus, he points out that November seasonality is historically strong for Bitcoin, like a 15% average return.
Okay, that is some extremely powerful directional conviction coming from serious players. But here's my skepticism, maybe push back a bit. Given all these bold predictions, $200K, $250K, $300, why are we consolidating now? Why did we just drop below six figures again? What friction are the bulls maybe overlooking?
Yeah, it definitely suggests the path isn't just a straight line up. While that institutional narrative is strong, and it's backed by people like Michael Saylor targeting $150,000 EOY, and MicroStrategy holding, what, 250,000 BTC now?
$250,000 Bitcoin, yeah.
Right. So the conviction is there. But the short-term friction is clearly liquidity extraction and that speculative unwinding we just talked about. I don't think they're overlooking the friction so much as seeing it as, temporary noise before those massive liquidity floods potentially arrive next year. So the key takeaway is that these macro views, they consistently project something like 40-60% upside potential by mid-2026.
Okay, that context helps. Let's pivot then to the health of the network itself. How is the underlying infrastructure adapting to this new level of institutionalization? Let's maybe look at the miners first.
Right. Miners are definitely transforming. You could almost call it infrastructure 2.0. Take HFE Digital, for example. They're making a major pivot into AI and high-performance computing, HPC. They're securing land for like 10,000 GPUs by 2026.
Okay, diversifying beyond just mining Bitcoin. Why is that pivot so important for the wider Bitcoin ecosystem?
Well, primarily it's diversification for them. This is projected to boost their own EBITDA margins by maybe 20-30%. And crucially, it mitigates about 40% of the revenue volatility that's tied directly to Bitcoin halvings.
Ah, right. Less reliance on block rewards.
Exactly. They're blending secure network operations with high-demand compute power. It just makes their business model much more robust against BTC price swings.
Okay, interesting. Now, looking at liquidity dynamics on exchanges, we have to note that Binance seems to be emerging as the epicenter of spot sales recently. They processed, what, 60% of recent outflows, about $800 million in just the last 24 hours? That kind of high concentration always feels like a risk, doesn't it?
It absolutely does. It reinforces the need for diversified custody,
Oh,
reducing counterparty risk by potentially as much as 40%. But if we connect this concentration to the bigger picture of adoption, we kind of bump into a more fundamental risk point, maybe overconfidence in these centralized entities.
you're talking about the erosion of Bitcoin's core philosophy, the whole be your own bank thing. What's the metric that suggests this is actually happening?
Yeah, the concerning statistic is that roughly 70% of all Bitcoin is now held in custodial wallets.
70%. Wow, that's up significantly.
It is. It's up from about 50% back in 2022. And this increasing reliance on centralized custodians, whether they're exchanges or ETF providers or corporate treasurers, it just exposes users to significant systemic risks. Everything from hacks to regulatory seizure, it kind of fundamentally undermines the self-custody requirement, that core ethos.
Okay, so synthesizing everything we've covered. The briefing reveals a market that is, well, structurally resilient. It successfully purged a lot of speculative excess. The macro signals still remain definitively bullish, pointing towards a projected $120,000 Q4 target, which, we're giving maybe a 65% probability. So for you, the informed learner listening in, these contrarian dips still seem like optimal entry points, strategically speaking.
Exactly. And this leads right into an important final thought, directly addressing that custody shift we just talked about. We know 70% of Bitcoin is now custodially held. We also know that institutional inflows, those ETFs, the corporate treasuries, they're driving the price appreciation that's linked to these global macro liquidity floods. So this raises a really important question. As all this institutional money pushes Bitcoin higher, does the increasing reliance on centralized custodians inherently compromise the very self-sovereignty, that bearer asset ethos that arguably gives Bitcoin its unique long-term value in the first place?
That is definitely something profound to mull over while watching this recovery potentially take shape. We encourage you to monitor those ETF flows closely and keep a sharp eye on any signals from the Federal Reserve for confirmation of that macro tailwind. We'll be here tomorrow with the next briefing.